Hi, everyone. We're going to get started in a second here. We're just waiting for a few more people to join. Oh, I see some people starting to fill in now. Letting two more people in from the waiting room. Okay. All right. I know this is being recorded, and some people have stressed or expressed an interest in seeing that. So I'll get started here, and we can start moving forward. So hi everyone, welcome to our webinar. 6 months in, lessons from building and scaling Nexyst Digital. Our panelists for this one are the three founders of Nexyst Digital, Val, Dimitri, and myself. So you're truly getting transparent, tangible kind of viewpoints, firsthand viewpoints on the business. We've scheduled for 45 minutes, but we might wrap a little closer to about 40. We want to be mindful of your time. So as a starter, I kind of want to remind everyone why we built Nexyst Digital in 2022. An investor in digital assets had two real options. They could buy digital assets directly themselves or kind of invest in long-only digital asset funds. Given the nature of the digital asset market, these funds tended to be extremely volatile, and those two kind of options tended to be extremely volatile. Given our team's background, we started exploring how to bring multi-strategy, multi-manager model kind of that was so dominant in traditional finance into the digital asset space. It quickly became clear that the market lacked options, kind of offering low volatility, uncorrelated to Bitcoin type return profiles. So after 18 months of internal testing, Nexyst Digital was launched in September of 2024. And just as we apply rigorous due diligence to risk management and trader selection, we've taken the same approach with our LP base, partnering with like-minded investors who understand the nature of digital assets and quantitative strategies that allow us to kind of grow this business deliberately and sustainably. And I mean, on that note, I'm going to share a slide here that highlights a few milestones for the Nexyst platform to have as a background. That's as we discussed the chronology of the past 6 months. So like I said, in September of 2024, the platform launched. The Delta Neutral and Dynamic Fund launched with 9 million in AUM and 10 total trading teams. In October of 2024, our Bitcoin share class launched. This was due to overwhelming client demand. We always had this on our roadmap. Our initial roadmap had this closer to the beginning of 2025, maybe even in 2025. But there was so much demand to package alpha and beta in the share class from Bitcoin investors that we really accelerated that and moved that up to October. In February of 2025, the platform redomiciled to BVI. Our AUM hit 35 million, which was a 400% increase from the September launch. And thank you to everyone on the call who was a part of that. The trading team count hit 20. And in March of 25, a big kind of move forward here at the platform was our Comenu integration. Comenu is a custodian based out of Dubai. And we utilize their technical integration to reduce our exchange exposure. And now 70% of our platform assets are actually in cold storage and not exposed to exchange risk, which is we're really proud of as fiduciaries and really managing kind of the safety of client assets. I'll stop there on our chronology. It's only 6 months. As always, I assume everyone's dialed in or joined via video is to hear what Val and Dimitri have to say about performance and risk management. And I'm an LP in a few different hedge funds and startups. So I've compiled a list of tough questions for both of them. Val's going to cover portfolio construction and performance, and Dimitri's going to handle risk management. And some of you have written in questions. Thank you very much for that. I'll handle those at the end. I might ask for an assist from Dimitri or Val. But without further ado, Val, you're up. So let's get started here. Val, how has the portfolio construction at Nexyst Digital evolved since launch?
Yeah, thanks, John. So, as you noticed here, we started with just 10 trading teams, which were split evenly between Delta Neutral Fund and Dynamic Fund. And over the last 6 months, we kept adding new teams and diversifying the return streams and different sources of uncorrelated alphas. It was easier to do in the Dynamic Fund just because that fund is unconstrained in terms of delta exposure. So the number of managers in the Dynamic Fund basically grew from 5 to 15 in 6 months. And we keep interviewing new managers. We have a healthy pipeline to add even more. And, primarily, we are looking at strategies that are performing independently of the market environment. And I guess we can go deeper into that.
Sure. And just to give everyone, put some quantitative numbers to that. When we launched, we had looked at about 200 different strategies or trading teams. And that was in September. I think that's doubled by now. So we're really kind of pounding the pavement looking for uncut, like hidden gems in the strategies and trading teams. And that number is over 400 now. So a lot of credit to Val on how much effort he really truly puts into finding the best strategies for the fund. So Val, I guess my next question, which I think everyone's always interested in, which strategies have outperformed? And more importantly, I think, which strategies have underperformed and why do you think that happened?
Yeah, so over the last 6 months, the first 4 months were pretty good for us. We had, amazing November, pretty good September, October, December. I think January, the performance kind of started to kind of flatline, and then February and March, we are having a bit of a drawdown. The underperformance is really caused by one particular type of strategies, which are volatility arbitrage strategies. So let's dig a bit deeper into what is volatility arbitrage, right? So I created this chart here, which shows this blue line is a difference of implied volatility and realized volatility of Bitcoin. And this goes back to January of 2022, from that time until now. So again, if you take implied volatility as implied by the options on primarily Deribit exchange, we look at pricing of those options and what is the forward-looking 30-day implied volatility. And then we deduct from that 30-day realized volatility, we get this blue line. And what we see is that very rarely is realized volatility above implied. So most of the time, this line is under 0, which means that implied volatility is higher. So actually, I'm sorry, this is inverted, right? So this line is realized minus implied. So most of the time it's negative, which means that the realized volatility of the market is under the implied volatility. And so the strategies that take advantage of this effect, what they're doing, they're selling options and then delta hedging. So the strategy is delta neutral. And on average, over time, these strategies are profitable because, as we see from this chart, again, on average, realized volatility is always under the implied volatility. But once in a while, you see these spikes when it goes above zero, and that's when realized volatility is higher than the implied volatility. And this has happened, a couple of times in 2022, and it is happening right now. So as you see on the right side of this chart, we see a spike which is actually pretty high. It's higher than any time over the last few years. Maybe it's kind of similar to what we saw in 2022.
Hey, Val, is there any relationship between these spikes and then what the performance of these strategies looks like on a forward 3 month or forward 6 months after these spikes occur?
Yeah, absolutely. So basically, what first thing that you can see here is this process here is strongly mean reverting, right? It always reverts back. It always drops under zero, which is where this volatility arbitrage is profitable. And if you look at, for example, 2022, after the spike, it went back down under zero and it stayed there persistently for multiple months, which means that the strategy was highly profitable after that spike. And there was a lot of arbitrage opportunities in that period. So that's what we consistently see in the volatility arbitrage strategies, is that after the drawdown, which is caused by a spike of realized volatility, it typically reverts, and then there is a healthy period where the strategy is outperforming. So that's what's happening right now. Most of our drawdown is caused by this spike in the realized vol, which happened at the end of February and first week of March. And now it's already recovering. Last 2 weeks of March, the strategy is already going back up. And we are expecting that next few months are going to be very profitable.
Right. Val, I guess could that be what's interesting is I know when we are looking at our strategies, a lot of the risk metrics that we focus on is correlation between the individual strategies in a bucket. So a bucket could be statistical arbitrage, momentum, funding arbitrage, volatility arbitrage. And even though they might have the same name or in the same bucket, we strive to have extremely low correlations. And what is there a component of this particular drawdown that saw an increase in correlation of those vol strategies at the same time? Is that kind of what happened in this particular case?
Yeah, so that's an interesting question. So, for example, when we look at momentum strategies, they're all trading Bitcoin mostly and other highly liquid tokens. And you would think that they will be highly correlated because they're trading the same instrument. But the strategies that we are selecting are not correlated because they trade at different times. They typically get into positions and out of positions at different times, and that's how the correlation between them is reduced. That's about the momentum strategies. Now, in the volatility arbitrage world, they're all trading volatility, implied versus realized. There are different flavors. We have a strategy that's doing it daily. We have a strategy doing it weekly, monthly, kind of different types of hedging and so on. We have 3 different strategies in this bucket. But the nature of this market is such that when the realized vol spikes, they tend to get, their performance tends to get highly correlated. So in this case, yeah, we got kind of hit by all 3 of them at the same time. And that's really typically doesn't happen if you look at their day-to-day performance. But again, in the extreme events such like this, it could happen, and it happened now, and that's kind of created outsized effect on the fund level.
Thank you. And there, I guess, how are you thinking about adjustments in response to this volatility, in response to potential macro trends, in response to liquidity shifts? How are you thinking about portfolio construction?
Right. So in terms of adjustments, as I mentioned, we keep adding new strategies in other types of in other buckets, momentum strategies, reversal strategies, pattern recognition, startup strategies. We are actually seeing kind of strong performance from some startup strategies this month because the market is not moving. There is no strong trend in either direction. It's kind of stuck in a narrow range. Well, the range is wider than it was usually, but still it's a range bound market. Bitcoin is not really trending. And so the strategies that are taking advantage of kind of dispersion in different token returns, such as startup strategies, are performing well, and we are kind of going to add more of those. We actually have one that's starting April 1st. So by adding more uncorrelated and diversified strategies, what we are getting is the reduction of the relative contribution of any given type of strategy, right? So again, we fully expect that these volatility arbitrage strategies will recover and will be very profitable. In fact, if you think about Bitcoin market in general and you ask yourself, why should you be making money trading Bitcoin? There are only two effects that are well known and very strong. One is the momentum. Everyone knows Bitcoin is generally a momentum driven market. And second is volatility arbitrage. Right? Everyone knows that volatility is overpriced and implied is usually above realized. And so those are two kind of bread and butter money making strategies in Bitcoin. And momentum, as we saw last month, is gone, and no one knows when it's going to come back, right? It could be next month, it could be in a few months from now, right? But volatility arbitrage is always there, and not only in Bitcoin. In any market, you look at any market, there is always a way to make money doing volatility arbitrage. So we're very bullish on this type of strategy. But again, as a percentage of the portfolio, it will gradually be getting smaller as we are adding other types of strategies.
Yeah, I think what a really important kind of component to look at here is we are macro agnostic. Like we are purely driven by the performance, risk metrics, and quantitative metrics of these strategies. So just because Val, myself, or Dimitri might think we're entering into a better macro investing environment, we don't adjust the portfolio on a whim or human discretion. We wait for the strategy's performances and their risk metrics to tell us what we should be doing. I think that's a really important kind of factor here. And right now it's showing that historically, where if you have a spike like this, an implied vol, that for the next 3 to 6 months, that's a really attractive area to have allocated capital to based off previous kind of return cycles. So I think it's like Val said, we're bullish on that spot. Val, I'm gonna shift gears a little bit here. And if anyone, by the way, has additional questions on portfolio construction allocation that we haven't covered here, or we might not cover after this, please reach out to me directly. We can set up some one-on-one time. We can discuss. So I don't want you to feel like if you had a question that we didn't cover, that you're not going to get that answer. So Dimitri, your time has come, sir. I think what would be a great background before we even get into it, Dimitri, is you have, I don't want to give away your age to the group, but you have 30 years experience on risk management in pretty much every asset class that exists. So
when you said my time has come, John, you really meant it.
Yeah,
I got it.
But
right.
can you give us like a background really quickly before we get into the risk management section on the risk management process and how that was set up at Nexyst just from the get-go?
Sure. So thanks, John. So yeah, let me talk about the current risk management process and talk about the toolbox that's available to us today and how we try to use it in the most effective way given its limitations and the idiosyncrasies of the asset class. Right. And also, if we have some time left, maybe share with you our vision of where risk management models need to go, something that we're currently working on, as we speak. So let's first maybe start with defining the landscape that we're dealing with. So a multi-strategy quantitative crypto platform like ours incorporates various algorithmic trading strategies, as we all know, which I like to group into three groups: Delta 1, Delta 0, and variable delta strategies. And I think these are kind of self-explanatory. Delta 0 mostly live in our Delta neutral fund, while Delta 1 strategies, so strategies which basically have direct exposure to underlying assets, whether it's like a mean reverting strategy or momentum strategy, these are all Delta 1s, or variable delta like a volatility arbitrage strategy with various delta hedging kind of models. So these three groups are all spread across diverse digital assets. Each strategy presents obviously unique risks, and managing their combined exposure presents a very special challenge for everyone, not just for us. Unfortunately, there are currently no dynamic or predictive risk solutions which are well developed and tested. And again, maybe at the end of this, if we have time, I can talk about our vision for those. So again, let me just quickly share with you our current process. And also, again, make some forward-looking statements about where we believe this risk management process needs to go. So firstly, we utilize a two-tier risk approach. One is on the strategy on an individual strategy level, and the other one across the entire portfolio. For each strategy, which is managed by individual traders, we set very simple, very easy to understand black and white rules. These are max net and gross exposures, yellow and red light stop losses, permitted products, right? We try to be as clear and as simple defining these rules for the traders, trying not to impact the strategy's alpha generation, and simply give the traders very clear limits as to where they need to, within which they need to operate. These rules are very clear to them. They're not designed, of course, to alter the strategy, each individual strategy in any way. On the portfolio level, however, our job becomes a little more complex, right? So the main risk management tool of any multi-strategy portfolio is diversification. Short of us playing around with some sort of a risk overlay or some sort of a portfolio-wide hedging, which we honestly, based on my years of experience, we dislike that. We believe diversification and proper portfolio optimization are the best risk management tools. And here's how we think about this. So look, so the current tools available to everyone, both in the traditional space, I mean, really mostly in the traditional multi-strategy space, are very straightforward. Everybody is aware of those. This is mean variance analysis. These are some sort of a value at risk, measurements. This is stress testing, scenario analysis, things like that. All of these models rely on historical correlations, static risk models, and predetermined assumptions of some sort, right? So traditional optimization techniques such as Sharpe ratio or mean variance methods often oversimplify or mix complex interdependencies amongst crypto assets, right? But unfortunately, these are the tools that's available across the industry to everyone who runs complex portfolios, and we're not an exception. So we deal with these limitations in a somewhat of a, I think, more intelligent way. But again, this is not a meaningful deviation from these traditional tools. We we obviously structure our portfolio optimization based on equal risk allocation. None of these strategies have exhibited a Gaussian or a normal behavior. By normal, I mean normally distributed behavior in the past. They're all non-Gaussian, and all of them have unique distributions. So our job is to try to determine, from looking at the history of these strategies, to determine the possibility and probability of fat tails. Right? How often, how frequent, how large can those be, and how those fat tails of a particular strategy might correlate with fat tails of other strategies. And that's really what drives our optimization process. This, frankly, is a relatively standard approach in risk management. Right? These methods obviously have significant limitations. I often compare, when I speak to investors, I often compare this to driving a car with windshield completely blocked. You're only using your rear view mirror. So if the road behind you is straight, you're going to assume that the road ahead of you is straight. And likely you're going to over-allocate risk in that case. Not a great solution, but that's really the only one. And of course, if the road behind you has had some major curves, you're going to assume that that's what's going to await for you ahead of you, and you are going to under-allocate risk. That's a persistent problem, and it's not a bug, it's a feature of risk management across every multi-strategy portfolio, whether they're crypto or anything else. So that's very high level, John. Of course, we can dive into more technical issues, more math-related issues. Rest assured that Val is a scientist, I'm an engineer, so we kind of like to think about these things very much in quantitative terms. We're very excited about potential applications of AI-based methods,
Sure.
which leverage deep learning generative models to continuously adapt and evolve. Just a couple of sentences about this before I sign off. So unlike traditional approaches, AI systems can really dynamically detect shifting correlations, anticipate emerging risks, and respond proactively to unforeseen market events like liquidity squeezes or volatility spikes that Val has just mentioned. And of course, we would benefit from this foresight, because unlike a traditional fund of funds or a multi-manager structure, which has certain liquidity limitations in how they allocate capital, we have no such constraints, right? So we can shift our capital daily or even on an intraday basis if needed, given the right set of forward-looking tools, which, again, to be clear, not available to us yet. We're very hard at work doing research, trying to understand what works and what does not work. Yeah. My pet peeve about applications of AI to portfolio management is that we have very rarely have we seen AI being successful in generating profit, consistently generating profitable trading signals, because it really needs to do multiple times, literally thousands of times, and be right most of the time. AI models in risk management, however, need to be right only every once in a while, but they really need to be right. Right? They're looking for these fat tails and for the market conditions that might be anticipated rather than looking at the rear view mirror. So that's with that. I think I've covered that, John.
I think it was no. Thank you. That was great. I do have. I mean, it's and feel free, Val, if you want to answer this as too. It's both of you. So Val had mentioned that the last, let's call it 3 or 4 weeks, we've had a recovery over the last, let's call it a week and a half, 2 weeks. But prior to that, we suffered our first drawdown. So did the risk system work, Dimitri? I guess is the question. The process and then the risk system, did it behave as we predicted it would behave?
Right. So just a few very specific examples. So in January, the lower level risk, which is the strategy-based risk system, worked once. One of the traders has hit their yellow and very quickly reached their red light stop loss, and we exited that strategy, immediately. Basically, the red light stop losses require us, to cut the strategy right away. That means something is materially and massively wrong, and we're not anticipating the strategy to recover. So that's one example. Frankly, I would say roughly 20% of the portfolio is turned over every year in terms of the strategies and the managers, and that's partially because sometimes the stop losses are hit on the strategy level. Sometimes the historical distributions that we expect out of the strategy have changed or shifted significantly, and we're now buying something that we did not buy before, right? So there is that. In terms of the most recent P&L drawdowns at the end of February and beginning of March, look, nothing is out of the ordinary. We see, as Val explained, right, the vast majority of this drawdown came from the strategies that we are very closely observing. We are very familiar with volatility arbitrage business, as we've done this for decades in the traditional space. They are expected to hit these types of drawdowns every once in a while. They were completely within the stop loss limits that we assigned to each strategy. So nothing was exited. We kept our exposure. So frankly, there were no particular red flags, even though the numbers indicate, the numbers show that this is an unusual event, right? This is the single largest P&L event for us in our history. And again, this is low single-digit event, right? We're talking 3-4% event. It's really, in the big scheme of things, it's really immaterial. And none of our traditional risk models have raised a red flag or anything that required us to materially change or re-optimize the portfolio. So basically, business as usual. That's the highlight.
Yeah, it's a great answer. And also, just to provide some behind the scenes for people who are listening, on the inner workings of once the volatility arbitrage strategies hit their yellow light that we call them, Val, like the system noticed it, and Val noticed the increase in correlation as well as the P&L. So he had actually immediately this next level of conversation starts with traders, where we have the ability to tell them to pause trading so we can investigate. It's conversations. Is this expected part of a normal return distribution? Did something change in the market that caught the strategies off guard? So you allow yourself this ability with this yellow before red to make an adjustment and say, you know what, that stop loss is actually not the right stop loss because our experts here on these strategies are saying something's changed. And so once you're allowed to perform that valuation and continue with the trading and continue with those strategies and let them run their course or cut them off. And so that was a lot of the conversations that were happening behind the scenes here at Nexyst during the last few weeks. All right. So Dmitry, I'm gonna thank you very much for that.
Before I sign off, John, if I may, I just wanted to introduce a new member of our team, which is which is the junior risk analyst right here. She's a Nexyst junior analyst, and I think in a couple of months she'll be fully versed in AI. So anyone having a question for her name is Sonya. Feel free to contact me, and I'll pass the Zoom call to her.
Yeah.
So there you go.
Yeah, that's going to increase our viewer count now, just with that dog's picture, I think, Dmitry. So yeah, we had some questions from the audience. I think we're going to have some time to answer more if you're willing. I have the ability to allow you to talk if you raise your hand if you want to ask a question, but I'll go with the ones that have been written in so far. The first one I'll take, it was, what's one key adjustment you plan to implement over the next 6 months at the firm? And it's going back to something we already started to do, but I really want to drive home the importance of counterparty risk management and our desire to shift exposure from exchanges to cold storage exposure. We'll be bringing, fingers crossed, our Delta Neutral fund into the Comenu network. the off-exchange settlement network, hopefully in a week or two. As a result of that, once that's complete, our platform exposure to exchanges will just be about 20%. I mean, our goal, and this is also very dependent on Komeinu integrating new exchange partners, but the reason we chose them is that we believe that we've underwritten their technology and how they integrate, and we saw their roadmap of who they're integrating with. And we believe that hopefully, and sometime in the end of 25 or 26, there will be a chance that we could have reduced entirely our exchange exposure. So securing, like I say, securing client assets in the digital asset space is utmost important. So you hear about exchange issues all the time. And for us, I think that is like extremely key implementation that you're going to see from us over the next 6 months. One of the questions Dimitri already touched on, which was how do you see risk management evolving in the space? Dimitri touched on it. What you don't know is that Dimitri is working on potentially a white paper on how AI can impact risk management. I think once that's available, we can share that with our investors.
Yeah, John, I think a white paper is an over, this is probably not the right term. It's more like a stream of consciousness, about my personal opinion. And we internally have disagreements, which are very healthy about the benefit of AI. But I'll be happy to share this with.
All right, I'll call it a blog then. We'll say Dimitri's blog.
Yeah, that's really all it is.
Yeah, all right. The last question I think is probably tailored for Val. Val, are there new trading opportunities that you guys have identified, but you haven't yet acted on?
Yeah, definitely. As I mentioned, we see a lot of potential in new startup strategies. We have, one new trader starting April 1st with that strategy. We have a few others who we are actively monitoring their accounts, and we see very good performance this year. Startup in crypto in general is challenging because typically startup relies on kind of stable statistical relations between assets, which in real economy, let's say you have airlines, you have obviously related businesses of those companies, and their stock prices will be related because they are in a related business. They have cash flows that are all shared between them, and so on and so forth. In crypto, it's much more challenging because a lot of these tokens are decoupled from the real economy and real cash flows. But still, we are finding talent, and we are finding traders who are able to devise more adaptive startup strategies that are profitable, and that's really an area of growth for us.
Yeah, that's exciting because that's an entirely new bucket that can add to the diversification. So and Val, could that be applied in both delta neutral and dynamic?
Well, so interestingly, in traditional finance, startup is typically a delta neutral strategy, right? But crypto is so volatile that it's very hard to make that strategy to be completely delta neutral. You will substantially suppress returns when you try to do that. So the strategies that we are finding, they typically still have about plus minus 20% net exposure and kind of higher volatility compared to delta neutral strategies. So they really belong to the dynamic fund as of now. Over time, we may find a way to turn them into kind of less volatile delta neutral strategies, and in that case, we could add them to the delta neutral fund.
Cool. All right, I don't see any raised hands, so I think that is it. Like I said, if there's any individual questions, feel free to follow up in an email. If you want some more time with us, please also let us know. We're happy to hop on a call. But on behalf of Dimitri, Sonya, and Val, thank you for joining. I really appreciate it. And if you are an investor, we appreciate your confidence in us. We're extremely bullish on what we're offering and where we see this going. And we hope that you share that same opinion. So thank you very much. I appreciate your time, and I'll see you on the next webinar.
Thank you.